Greetings and welcome to the Pinnacle Partners Opportunity Zone Fund 8 portfolio update. My name is Jeff Feinstein. I'm the managing partner at Pinnacle Partners. We're very pleased to be with you today. I'm joined by my partners, Leo Backer and Jill Holman, Pinnacle Partners, and our special guest, John Scheretti from Novogradac. Our agenda today is to provide you first a current state of the OZ market and review of proposed extensions. We'll get into that in just a moment. We want to overview the current portfolio construction of Pinnacle Partners OZ Fund 8. We last met together near year end when we launched the fund of 4 multifamily opportunity zone projects. The intention was to curate a portfolio of high quality multifamily projects in growth markets. We had an expansive pipeline of opportunity, and we have since moved through the underwriting process to now secure 3 of the 4 projects. We think this is market leading in its size, its targeted selection of high quality projects in unique locations. And we're very pleased to provide an update to you today. We have many attendees today, and I'm certain that we have a great number of our current investors. So I want to first thank our investors for their trust and partnership. This will serve as a real-time update to our portfolio construction. We'll have an opportunity for Q&A, and we'll facilitate that at the conclusion of the presentation. For those of you that don't know Pinnacle Partners, we are an early mover in the execution of the Opportunity Zone legislation. Our first fund was formed in 2018, soon after the legislation was enacted. We've since executed on 9 discrete funds, capitalized close to $600 million of OZ development. We will deliver approximately 1,300 multifamily units, our product of choice. And by creating 9 separate and distinct funds, we've gotten very good at the execution methodology, and in particular, invoking institutional quality underwriting, ensuring that we source the highest quality projects that stand on their own before the tax benefits are added. We think that's our unique edge. So just a very quick primer before we move to John. Why invest in opportunity zones? We're not going to go through the extensive kind of overview of the program. We're going to assume that the audience is generally familiar with opportunity zone investing. To score the point as to why opportunity zones can be compelling as a tax shield, I refer you to the graphic here on the right side, my right side. This was on Monday, April 18th. Fairly well-known CNBC contributor Tom Lee of Fundstrat estimated that Americans paid last Monday $1 trillion in capital gains tax, the most ever. And given current volatility of the markets, as he notes in the tweet, lots of furious cash raising to fund taxes. Well, for those that aren't aware, there is a tax shield, a very efficient tax shield available in opportunity zone investing, where you invest capital gains and you enjoy significant tax benefits, as well as exposure to institutional quality real estate, which serves as diversification, which serves as a non-correlated asset, many call alternative asset or real asset, which we think is quite valuable given the current inflationary cycle. So I thought that certainly made the point. And opportunity zone investing has been in place since 2018. We are going to go to John Scheretti, who is partner at Novogradac. Novogradac is the nation's leader in the application of federal tax programs. That could be LIHTC, but certainly has been opportunity zone investing. They have influenced policy. Most recently, last week, they had their spring opportunity zone conference, And so we're going to go to John to describe the state of the OZ marketplace, the number of inflows that have come into the program, and report on some recent proposed legislation that would extend and potentially expand the OZ benefits. On your screen at the moment are the two benefits enacted and in place today. If you're to invest in an opportunity zone, you will qualify for investing capital gains, short or long term, temporary deferral of the capital gains tax, and ultimately permanent exclusion or tax exemption on the appreciation derived from the real estate investment. John, go to you now for the latest real-time update on opportunity zone market and proposed legislation.
Thanks, Jeff, and thanks for asking me to be here. As Jeff said, I'm with Novogradac and Company. We're a community development finance group, primarily tax incentives around real estate. And we're very active in the opportunity zone space, have been since inception. And with respect to the marketplace, we actually conduct a survey that we've been conducting since, I'd say, early 2018, which is when the investing first started. And I'm happy to report that based on our survey, investing has been very strong. We don't capture the whole marketplace; it's anecdotal, but we do survey about 1,000 funds, and they're all multi-family, multi-investor funds. So there's lots of opportunity zone investments that are captive or sort of under the radar, and so we know that we don't capture the whole marketplace. We think it might be about 25%. So the real numbers are most likely 3 to 4 times higher than what we capture. And when we look at 2021, it was a huge year for opportunity zones. We had surveyed $20 billion invested, and that was 61% over the 15 billion at the end of 2020. And so there was a sort of 61% increase in our survey results to 20 billion. And there was a lot of questions as to whether the basis step ups of 10%, what was left, you get this 15% basis step up. 5 sort of went away a couple of years ago, and you had this 10%, and last year, the end of 2021 was the last year to take advantage of that, as to whether that would slow people down. It was a huge year in 2021. The stock market was, record highs, looming inflation. There was lots of M&A activity, lots of gains. And so there was this sort of question whether we would see this continuous investment opportunity zones in 2022. And in our survey, again, it's anecdotal and just a subset of the marketplace, showed $4 billion invested in the first quarter, which was 3 times what was invested in the first quarter of 2021. So by all indications, this momentum is continuing in opportunity zones, despite the fact that we don't have the basis step up. When you look at the math around the basis step up, it's probably worth about, the 10% was worth less than 50 basis points. So if you're looking at a 10% investment, 10% return after tax, let's say, the opportunity zones itself is going to give you 300 to 400 basis points on that, on an after-tax basis, based on the let's say a multiple, maybe 2 at the exit, and then not realizing, not having to recognize the recapture on the sale. So you're talking about, instead of getting 14%, maybe you get 13.5% after tax. And so it's just in that math, that 10% didn't mean much. So I didn't expect folks to stay away from the program just because that incentive wasn't there. But that's sort of where the marketplace is anecdotally. We're seeing this, energy continue to invest in opportunity zones. there is, as Jeff said, some proposed legislation out there to extend the program. The legislation is actually sponsored by Senator Cory Booker and Senator Scott, who were some of the original co-sponsors of the bill. So it's bipartisan, it's bicameral. We also have some heavyweights in the House. And so we think it has, its best chances, any chance of passing if we get it into a wider bill. I mean, these bills don't, come to the floor alone. They're usually tucked into a wider bill. And so we expect that if we were so lucky to see it pass this year, it probably wouldn't be until a lame duck session, assuming it is a lame duck session. At least that's what all the signs are. But there's typically a year-end tax extenders bill that is usually bipartisan, and usually both houses cooperate around the tax extenders bill, even if it is a lame duck session. And so we expect the best chance for this passing this year would be in a tax extenders bill at the end of the year. And so we're hopeful. If it doesn't get into a wider bill this year, again, it has to be sort of a tax title bill, then the fact that it's bicameral and bipartisan, even if the majority went Republican, we think the fact that it's bipartisan, bicameral, that the Biden administration wouldn't be likely to veto the bill. So it's sitting pretty strong, and it's it not only has an extension, which we'll talk a little bit about, but there's some trade-offs that the Democrats were interested in, like reporting in the sunsetting of some of the high income tracks. Very few tracks out there, very low, small percentage of tracks that they've been sort of wanting to phase out or sunset in the program. But the extension itself is a 2-year extension. There was just took about 2 years for the momentum to really start in the program as we waited for regs, and folks just having to get through the learning curve of understanding the program. And so that's why they're asking for 2 years. What that means is that currently in 2026, that's the general inclusion event for folks that invested from 2018. And it would just extend that for 2 years, even if you've already invested. So it's kind of a nice extension. It's not like there's 2 tranches where one tranche ends in 26 and one tranche ends in 28. Everyone would get 2 years. And then it also provides for an opportunity to reinstate both the 10% and the 5% step up. The way the 5% works, because you had to hold your investment for 7 years, which we only have 6 until 28. And so the 5% step up, the bill moves it to a 6-year investment term. And so if it were to pass, and you were to invest by the end of the year, that's a tight or a narrow window, then you could get the 15%. I suspect, probably it's not going to enter a wider bill as it sits today. There'll be, we have a working group that we're actually making comments to the legislation. And then a lot of times when things pass a little later, they might provide for this 15% to still survive, where, they somehow make it 5 years or something like that if the bill were to pass, later or in a 2023 date. And so anyway, but that's sort of what's in that. Another feature of the proposed legislation is this fund to funds concept. And what that means is currently a qualified opportunity fund can't invest in another qualified opportunity fund. So if you were to say if you happen to make an investment in your own fund that you set up and you wanted to go into sort of a multi-investor fund, a lot of times we see we have to sort of joint venture these things in a side-by-side basis. It makes it complicated, and because you can't today, under today's law, you can't a fund can't invest in another fund. And so this proposed legislation provides that a fund can invest in another fund as long as 95% of the assets of this sort of upper tier fund make it to the lower tier fund. And the objective of this provision, I think, is to allow for, smaller funds to participate in a diversified larger portfolio. And so we think it's a great feature. It will be widely accepted and have a lot of utility in the marketplace. So that's another feature of the legislation. So that's all I have, Jeff.
Yeah, well, thank you, John. It's a great overview on the marketplace, on the proposed legislation, and really the process to get it enacted. And we appreciate your confidence, optimism that it will be. So let me just, we're getting Q&A, and I encourage people to use Q&A button on Zoom. But let me just ask two salient questions, I think, that apply to this audience. Number one, if you'd invested in, say, our fund in 2020 and the extension has passed, could you describe very quickly what the benefits would be? And I think you said this, but let's just reinforce, if you invest in 2022, this year, say you theoretically invested early December or maybe tomorrow, and it passes, what would you be, what benefits would you achieve then?
That was a question. You're asking me the question?
Yes.
I'm sorry.
Yes,
I'm sorry. Yeah. So I didn't get the first part. The second part, yeah, if you invested today and it passed, you would have, the deferral of your gain to 2028, which, gives you an extra 2 years of deferral, which is a huge part of the yield. It's a the deferral, people, when you look at yours, we sort of talk about this 300 to 400 basis point increment, on the yield, and deferral is a big part of that, because you're essentially borrowing money from the government at zero interest for however long you get into that deferral period. And you also, if you invested today, you would, in the bill pass, you would get the full 15% basis step up, which essentially means 15% of your originally deferred gain would be excluded in 2028.
Right. I call it a reduction or discount of the tax bill at that point. Very good. Well, thank you, John. There are more questions coming in. We'll try to deal with those at the end. I do want to put a quick poll question out there, if we can get people to respond to it before we move on to the portfolio update. Leo, you've got a little Bluetooth menu. If you could close that, please, on your screen. Thank you for all of you that are responding to the poll question.
Hey, Jeff, I have a Q&A here about the potential impact to existing Oz projects.
Thank you.
So I can address that just briefly. There is a transition period, and it's very generous. The phase out, we think it's going to be less than 100 tracks when you look at the math. I mean, these are high income tracks, and if you happen to be targeting a tract and invested as little as 250,000, or can sort of prove you would lose money by those tracks being sunset, then the government provides this sort of transition rule where that would still be a good track. So we don't see it being much effective any on the marketplace. And knowing Jeff's investment targets, I don't see it being much, if any, of a issue. So
okay, and to be specific, it's the term of being applied is sunset, so there'd be a period of time. Our objective here, and maybe it's a perfect segue into the update on the portfolio construction, is we've targeted these growth markets. They are indeed, current and active OZ tracks. And we have high confidence, or complete confidence that, they will continue to be in force as the OZ program continues. So again, thank you, John, for the real-time update on the state of the OZ marketplace and a review of the bipartisan proposal. So it's good to have that kind of context as we move into the portfolio update. So my partner, Leo, will take us, along with Jill, take us through the identified projects for Pinnacle Partners Multifamily Fund 8.
Great. Well, thanks, Jeff and John. Great insight. I mean, there's a lot of technicalities, of course, of OZs that we've been, as Jeff said, in the forefront since the inception, and Jill certainly has, even longer than we have. So pleased to be here. Again, I'm managing partner at Pinnacle with Jeff. Jill Homan is a managing director, and very pleased to have her join us. And I'll kind of explain, how Jill became a partner with us in our fund. But I really want to start, well, first off, thanks for everyone for joining. As Jeff stated, I think we have a lot of our existing investors, both in our single asset funds, but also in our Pinnacle OZ fund. So this is a great update for all of you, and also a lot of folks that we're, seeing for the first time, and welcome. Again, a lot of technicalities with OZs, as we all know, and my role with Pinnacle is really sourcing the projects with my real estate background and network of developers. And now with Jill on our team, Jill, I was fortunate enough to meet about a year and a half ago. I was introduced to us by one of our board members, and Jill was early on in OZs in Washington, D.C., kind of on the Hill, kind of, looking at the bill as it was being written and helping with that, but also has been involved in advising family offices and investing in real estate funds, as well as developing an opportunity zone. So we've been talking for Jill, I think, over a year and a half now, of how we could find a project to work on together. She was in DC at the time and now is in North Carolina, and Jeff and I are out here in Seattle. And what a perfect way to bring kind of her expertise and team, and with her brings a great analyst, and our team on the West Coast, and our joint relationships, frankly, from East Coast to West Coast, and Jill's background in the OZ space is truly opening a lot of doors for us, from sponsors, as well as helping us underwrite the specific markets and ultimately the projects that we're going to review today. So Jeff mentioned, we have funded 9 single asset projects. One of those has been built and completed and leased, or not leased, and sold, actually. And that's kind of another webinar in the day. You actually can sell a project if it's completed prior to TCO, and we reinvested those funds in another one of our projects. We've got one project that's just been completed in Tacoma, Washington, an adaptive reuse high-rise office building converting to residential, and 5 under construction. So suffice it to say, 9 single assets, 9 joint ventures, all in opportunity zones. And the theme really was and is finding projects that we would invest in, even if they were not in opportunity zones. Every one of those projects were either acquired or under contract before these developers even knew it was an opportunity zone, which really is our theme today. And I know a lot of people say it, but it truly is the case for us, is we will not go into a project just because it's an opportunity zone and overpay because of that. So, that is the theme we're taking to our multi-asset fund. And why are we doing a multi-asset fund? All of our projects to date have been in California and Washington. 3 in California and 6 in Washington. And a lot of our investors have asked us to look at diversifying into other markets around the country. So that's what we've done. And we also thought multifamily would be the right asset class to focus on, which we think, in hindsight now, is a great hedge against inflation. It's a long-term hold. It's a great, income producing asset over the long term. And these other asset classes, such as industrial and office, there's a lot more volatility, for market conditions. And we think multifamily is the right product type for us for this asset class. We've invested in all types of multifamily, from senior housing to workforce housing, market rate housing, and student housing. And the fund is really focused on primarily market rate housing, We may look at a student housing project in the portfolio, but what you'll see today are 3 truly market rate, multifamily projects. So, again, with Jill's help, we really looked at all of the funds in the marketplace, and we wanted to make sure that we were the most competitive fund really out there as far as a fee structure and really the most compelling projects, in the market. We did not want to be a blind pool fund. We wanted to make sure, and we actually did launch the fund, as many of you know, at year end, and we actually started kind of putting our fund structure together even 6 months before that. And our first project we're going to talk about, we've been working on for about 8 months. That's going to be the first one really to seed the fund of the 3 we're going to talk about. So it just takes a lot of time, and we've officially launched year end because a lot of our investors had gains they wanted to invest prior to the step up expiring. So we did raise some funds by year end and are continuing now forward. And these markets you see here are very intentional. As I mentioned, we were focusing in just Washington, California to start. And that was really because the sponsors we had relationships with, we knew those markets. And our advisory board for the Pinnacle Partners initial projects was really West Coast based. With our fund structure now, we have really included more of a national scope to our advisory board, who have helped us, really analyzing these markets. Walt Smith with Avenue 5 Residential, they're one of the largest property management firms in the country, really helped us with analytics in each of these markets, and each project we look at in these markets, their firm helps us on our market studies. So if you look at the map here, you probably won't be a lot of surprises. There's a lot of these growth markets that are, we really follow employment growth, migration for quality of life, and positive good tax structures, and really, promoting businesses to grow in these areas. My prior career was representing a lot of companies relocating to cities across the country, and we used a lot of labor analytics in looking at why these markets, are thriving. And so much of it is why we're investing in those is close to major universities, major employment hubs, quality of life, relocations, et cetera. So, these are the markets that we've really been focused on over the last year or so, right, Jill? And looking at, dozens and dozens and dozens of projects, in these markets. And when we look at these markets as a whole, then we kind of look at what are the OZs in these markets, and where are the OZs that we think make sense for multifamily. And, Jill and I have spent a lot of time traveling to these markets, meeting with, economic development and developers and architects and a lot of stakeholders in these markets to find out really where we think, the growth will be, not just where it is today, but where we think the next opportunities are. Because a lot of these markets have seen a tremendous amount of growth. And, we don't want to be following all of these positive attributes. If you look at this study here, if you look to the far right, these are the highest growth markets, in the country for rent growth over the last year. And, won't be a lot of surprises here, the Austins of the world and these Florida markets and Phoenix, so we don't want to just follow these markets because there's been so much rent growth, right? We want to make sure there's going to be sustainable rent growth over the next 10 years, but primarily over the next 1 to 3 years when we're looking at securing these projects for sure. And then we think they're not going to get overbuilt in the near term. So you'll see the star next to here and a little prelude to our presentation, but the 3 markets that you're going to see that we have secured projects in are Atlanta, Nashville, and Denver. 3 markets we're really excited about. They are 3 markets that a lot of my corporate clients that I used to work with were looking at relocating to for a lot of the reasons I told you about. And we're really excited to be able to secure, projects in those areas. And frankly, sooner than we thought. We were hopeful to have 2 of 4 in our fund, to be able to present today, but we just secured our project in Atlanta that we're very excited about. So now we have 3 of 4 that we're going to be able to talk about today. So I'm going to go into real quick, kind of high level, why this market, and then Jill's going to go through the actual project information. We're going to take maybe 5 minutes per project. and then leave plenty of time, towards the end for question and answer. But again, we couldn't have, succeeded to where we are today with Jill and her team's, experience. And it's just been a real good partnership because, you're seeing the three of us here on the screen with Just Picture is our investment committee. The three of us, have to approve each project that we move forward on. And then we have our advisory board, which also includes a gentleman who's one of our largest investors. We do have a limited partner advisory board that Chris is the first one on, which really adds, a lot of, I think, great oversight on the limited partner side, and actually someone that's not in the real estate world asking a lot of important questions to us and really high level reviews. So with that, the first project that, again, we've been working on for over 9 months, Jill, I was looking at the emails today, is in Denver, Colorado. And, we've traveled to Denver. Jill actually sourced this project because she knew the sponsor, Mortensen Development. Mortensen Development is the development arm of Mortensen Construction, who's a very, long-term construction company based in Minneapolis, and they've been in Denver as a development entity since the 80s. And I've done a lot of work with them in the Seattle market on the construction side. And they had this project under contract, and Jill was looking at it, and we've been really working on this for 8 months. And the beauty is, we haven't even had to close on the land yet. So we've been able to tie up this project, get our joint venture term sheet executed, and we'll be executing our joint venture this week. Denver, as a lot of you may know, has been a really high growth market. The downtown has gone through a transformation. This project is literally, a half a mile from downtown Denver. The project is right next to the Denver Broncos Stadium. So it's part of a very large kind of rehab district that the Broncos control a lot of the land around here by the stadium that they're looking to redevelop. And we're also within a mile of a major university, Aurora campus, which has 3 campuses for the 3 large colleges in Denver, the University of Colorado of Denver, Denver Community College, and Metropolitan State University of Denver, which has 40,000 students. And we're also about, a 5-minute walk to a light rail station, which will take you right to downtown Denver. So it's got a lot of attributes. A lot of growth in Denver has occurred in downtown, on the other side of downtown in the Rhino District, of course, in some higher end areas like Cherry Creek, and on the other side of the stadium. But this is kind of on the forefront of what we think is the next neighborhood of growth in the Sun Valley neighborhood. There's 2 other projects being planned that will be happening in the same area, which we like, because this neighborhood is going to get started with 3 projects. And we think we have the best site, which is adjacent to the river and a jogging path and a lot of outdoor spaces, which is going to connect us both to the stadium district and downtown. So with that, Jill, I will let you start with kind of a quick overview.
Sure. Maybe you could start at the previous slide. And just to be clear, the star here is not necessarily what our project will look like, but this is showing when the stadium district is built out, what it will really look like in our projects being built. And then and there's already a number of there's one project that is also being built. But our location next to the South Platte River and the trail is really excellent because you can take your bike or walk or run to the universities or downtown. And this is a really compelling location as you think about the pathway of growth. So if we go to the next slide, we'll talk about the overview of the projects. And so this project's about 190 multifamily unit with on-site parking. The project originally was conceived as, the developer was contemplating potentially all studios in ones. And so we came in and wanted to put in some stacks of 2 bedrooms. And so that's what we did. And then what we've also done is really try to, since we're right on the trail, the river trail, there's some really cool design opportunities to incorporate our kind of fitness area and have it expand out into the trail and just really make it a unique project that fits really well with the lifestyle in Denver. This is a by right project. They're finishing up the site plan process with staff, and we're expected to start construction here in the second half of 2022 and turnaround delivery by the end of 23. As you all probably know, the Denver market is continuing to be a very, very strong market. Absorption has surged to a record at the end of 2021. And also what we've seen is just the overall rents in the market are continuing to grow. And we saw that as we came out of the pandemic. And as we looked at our comp set, we've continued to see significant rent growth within our comp set and surpassing where we've really been underwriting to. As I mentioned, this sits along the trail system. It's also, just to give you orientation, it's about a quarter mile to the stadium and less than 2 miles to downtown and all of the jobs there. The universities have about close to 50,000 students, and it's also connected to regional transit. And then Mortensen Development, if you're not familiar, is a legacy construction and development company based out of Minneapolis and have significant development projects in the pipeline. The land, we're very pleased about our basis overall in the project, with land being purchased at $4 million. And this investment would be approximately $25 million. In our underwriting, we're underwriting to approximately a 5.8 untrended return on cost. And I think some of that is driven by really, as Leo mentioned, we started working on this project a number of months ago. So this has been in the works for quite some time. And so I think some of our pricing and just the overall, land basis and rents. So land basis has locked in, a number of months ago, and the rents have continued to move in a positive direction. I think that's what we're seeing in our very strong return on cost. So that's the Denver project, and we're gonna maybe skip into.
Yeah, Joe. Maybe really quick, just before we leave Denver, I just want to add, as everybody knows, we're in an inflationary climate, and I think having a sponsor like Mortensen, having a GC as your partner it's got its pros and cons, right? The cons is that's one of the reasons we've been working at this for 9 months. We have to make sure that we have our contract negotiated both for the development JV, but also for the construction. So it's taken us a while to get to a contract with them for both. But with that, we've been able to ride this for 8 months and get some real time pricing for this project, which is critical, because a lot of projects you do not have the ability to ride for 8 to 9 months before you close on land. So we think that, again, we've really been buttoned up with legal on this, and we feel very confident that this project to us is a really prime one to start seed the fund with. So the next project is in Nashville, and I guess a story on the other side. This project we have not been working out for 8 months, and we've already closed on this project with the sponsor, and it's a very similar theme to this market. Is Nashville has been a very high growth market, and even though it's been such high growth, it's very undersupplied for multifamily. And most of this, you'll see the slide here of kind of the markets that are the most undersupplied, and Nashville and Denver, come up in the top two. But a lot of growth that's happening both in employment growth, but also a lot of folks are moving there for quality of life, for the tax structure, et cetera. So a lot of major companies are moving to Nashville. And this is a similar district. And a lot of these opportunity zones are in areas that are more industrial in nature, close to stadiums or close to universities, or in downtowns that are maybe more of the areas of downtown that need more investment. to fuel its growth. And this is very similar to Denver in that it's right next to the Titan Stadium district. But Nashville, if you haven't been there, it's a pretty small city where we're literally right across the river from the downtown CBD, very close to the other submarkets. And the two prime opportunity zone districts that we looked at were both this East Bank neighborhood right here in across the river from downtown, and then it's called the Wedgwood Houston neighborhood, which is just next to the Gulch area. So this property was put under contract by Stillwater Capital, who another developer that Jill had a relationship with out of Dallas, and very strong multifamily development entity. And I'll tell you another theme of all three of these projects. All three of these sites were purchased off market, which we really like, because as soon as projects get put on the market, they're going to get bid up. And this one is another one where we really feel good about our land basis. The location, we think, is on the 50-yard line of both. You'll see here our site in the middle, right in the middle of the district here. Oracle is building a major campus with over 1 million square feet here, literally a half a mile from our location. And then there's a very large development called River North that's under construction, also next to Oracle's campus, which is going to be mixed use residential, retail, and hotel. So this area is already improving. And then on the other side of our site here, you've got another major development, a 3 million square foot mixed use development that is in the planning stages. And by the way, these are already under construction. This will follow us. And then the Titans with Hines Development have a major redevelopment plan. You might have read about the Titans stadium, got an approval to rebuild the stadium and relocate it adjacent to here. And this whole neighborhood district is going to get improved, similar to what we saw in Denver. So this is really the next prime growth strategy in Nashville. And the reason that Stillwater really liked this location is that most of the development has happened downtown. And downtown, you have to build more high-rise type product, which is more expensive. And we like being able to build more of this mid-rise, high quality, but mid-rise product here, and not in the busy downtown district where this is more of a walkable neighborhood. This shows you kind of a quick slide on Oracle, but Jill, do you want to maybe kind of start here and then we can kind of dive into the project?
Sure. So with this project, Oracle is, as with so many of these companies, as Leo mentioned, are very significant demand drivers. And this is around the corner from our site. It says 20,000 plus jobs have been created since 2018, and just 41,000 have relocated to Nashville from California. So, and those 20,000 were from Fortune 500 companies. So just a lot of desire for employees, as y'all know, to move to Nashville. And what's been terrific is just the cost of living is still very, I guess, reasonable for all of this development that's happening, of all of this demand that's coming in online. This is a multifamily project with 373 units. It's about 373. We're close to parity on the parking spaces. And I would say very similar to the previous project, there's no retail in this project either. We're expecting to start construction with final approvals at the end of the year, and with completion by 2025. We talked about the in-migration and the population growth, and we've already talked about that. But we think with this being really Class A multifamily, fully amenitized, at a strong price point in an area that is right in the pathway of development, we think this will be a very compelling location for a 10-year hold. And then I just want to see if there's other. So just with this, we have it's a larger project, so larger land basis. And with this project, we're anticipating investing about $37 million in equity in this project on a 90-10 deal. Our untrended return on costs is a little bit more than a 5.1, and that's on our numbers. And then here, this is still a location with very compelling institutional cap rates, at 4 and sub 4. And so we like our going in return on costs, particularly for the rents that we're underwriting. And we think this will be a strong rent growth market, and standing in the pathway of development. We think this will be a good long-term hold as well.
Yeah, and just to add, Jill mentioned our underwriting. We don't take the sponsors' models and call that gospel. It probably sounds, no surprise, but we don't. And so we'll come in with most of our sponsors work with Greystar, which is probably the largest property management firm in the country, and work with them on their unit mix and pricing. And then we use Avenue 5 or other local property management firms for our market studies. We tour comps in the market, and we truly, add what we think market rates should be. And then we also increase, we normalize, expenses and rent. We equalize rent and expenses at the same percentage, where a lot of developers play the game and don't, raise those at the same percentage. And we also increase cap rates from today's cap rate to what we think is a reasonable increase per that market. So this is our underwriting. Our sponsors, will typically be, at least, 50 to 100 basis points higher, in their underwriting. So now the third project of the 4 is in Atlanta. And this is one that literally yesterday we just came to a formal agreement on the term sheet. We actually had a term sheet agreed to about a month ago, and we went in and actually renegotiated a bit because we were at our underwriting, as we mentioned, it didn't hit the threshold that we were happy with. And we were able to negotiate better terms with the sponsor that now, we do believe in this project based on the returns. And this one is very similar to a project we just are completing in Tacoma, Washington. It's a office building that was built in the 1960s. The one in Tacoma was actually built in the early 1900s. And it's an adaptive reuse project. This building is right in the middle of downtown Atlanta and very close to a major university, Georgia State University, which is the largest university in Georgia. Our sponsor, Atlantic Companies, is actually just completing a student housing project right next to campus. It's also got an office and commercial district surrounding it, several government buildings, including the state capitol, and many healthcare facilities. So it's right smack in the middle of downtown, in an opportunity zone, of course, in an area that, pre-COVID, offices were expanding, and there was residential being built, and it was becoming more of a 24/7 type community. Actually, another OZ group bought this building 3 years ago to convert it to Class A office. And they completely gutted the building. They put in new windows, and then the pandemic hit. So they slowed their program down. Our development partner knew the sponsor, who approached them to see if they would have any interest in buying the building. And they're the ones that came up with this adaptive reuse to multifamily for this project. And again, that's exactly what we did in Tacoma, Washington. And that project has proven to be extremely successful as we just completed it. And what we like about this project is not only location, right smack in the middle of all of this employment and university. We like that it's adaptive reuse because we're going to have a GMP in place with the general contractor prior to starting construction or prior to finalizing our joint venture. You can see the buildings, it's been gutted. So I think the assurances on cost is going to be a lot greater than new construction, and the time to market will be a lot quicker. So we're really excited about this project. Again, adaptive reuse, very high ceilings, and I think it's a differentiator from the other typical, new construction project in that market. So Jill.
I think that's what stands there now. It's been gutted, and then do you want to show the other? There, that's the rendering of the project.
Yeah, the other thing to add real quickly, so we underwrote this project, based on, the NOI that they presented to us, but there are two very major, tax incentive potentials to add on to the OZ benefits here, and that's historic tax credits, as well as potential other, land property tax credits in this district. And we aren't using that in our underwriting. All of that will be an additional upside to this project. So we've underwrote it conservatively to the numbers that Jill's going to go through, but we think there's a high probability that there's going to be quite a bit more upside in this project, which is another reason that we think it's very compelling.
Great. And so if you'll go to the next slide. So with this project, we're about 286 multifamily units. We have significant amount of parking on site. We also have, I would say, a small coffee or small kind of co-working or coffee, a little bit of retail, a very, very small amount that we can use or incorporate as an amenity into the property. The project can begin very quickly since it's an existing building. And so we're set to start construction within a few months this year, and then with delivery by the end of 2023. So this, as Leo mentioned, so this sits essentially at the campus of Georgia State University. It's a major university in downtown Atlanta with about 6 campuses. And so there's a total enrollment of Georgia State University students of about, call it 50,000. And within this campus, I think there are about just under 40,000. Within a 2-mile radius, we have about 173,000 employees and 9,500 businesses. And this sits within good transit access to all of greater Atlanta with Buckhead and Midtown, as you all may be familiar with. The developer, is Gateway Ventures. So that's a development company that I've done business with in the past. And they have about 40-year track record in the industry. Our land basis is really higher because of, we're acquiring a building and using that so that there's, it is accretive to acquire the building and, reduce our, some of our development risk associated with, with building. And so we'll start off with, with the base building and then put in the systems and the interiors. And so that's really what this project's about. With this one, we're anticipating about 31 million in LP equity for this project, and similarly about a untrended return of cost of about a 5.1%. As Leah mentioned, we have some opportunities with historic tax credits and others to enhance returns, and that's what we're exploring with seasoned historic tax credit professionals. But I would look at that as upside, and we'll find that out as as we're proceeding down the path. But that won't get in the way of us, continuing to move forward and finalizing the project.
Thanks, Jill. I know we're coming up against our time and want to certainly answer a few questions. Real quickly though, as Jill mentioned, we've got these 3 projects and they're all in various stages. However, they're all teed up to start construction this year. So as we are selecting these 3 projects as our first, of the 4, and our pipeline of the balance, we're looking at probably 6 to 8 projects right now in Austin, Dallas, Salt Lake City, Bozeman, in our, core markets that we're really, focused on. And, I think fairly soon we'll be able to announce the 4th project as well. So with that, Jeff, do you want to kind of take over for a quick summary?
Yeah, well, again, thank you everyone for attending. We hope this has been a fulsome update on our, what I think is tremendous progress to identify and secure 3 of the 4 of the boutique Opportunity Zone Fund. I hope that we presented and it is clear that we're investing in very strong submarkets with attractive risk-adjusted rates of return before tax benefits. And you heard from John earlier, the potential lift between 300 and 500 basis points or 3 to 5% increase to the IRR. We're creating JV partnerships with some of the most experienced and best-in-class developers in these local markets. And this is not a blind fund. We are actively identifying, and will allow each and every investor to move through our diligence together as they make an evaluation of our fund for investment. So thank you everyone for that. I think there are a couple of questions I tried to ask or answer rather a few, but I think one, Jill, I'll ask you to respond to, and that's to do with our process for locking down, to the extent possible, material costs and trades. So as we move forward towards development, as we discussed this summer and into early fall, we want to ensure that our pro forma is something we can execute to.
Yeah, I think he's asking about the specific Denver deal and what's been finalized. I think he's responding to a comment Leah made in the contract and what's outside the contract. We're signing a cost plus contract with Mortensen, with their construction company, and that what's in and what's been finalized is with. I would just characterize it as we're finalizing our pricing with Mortensen on that contract, and so that's being nailed down as we speak. So I can't really speak to the major trades since that's we're getting pricing from them as we speak.
Yeah, and it's critical, these sponsors that we work with, that they have relationships with the GC community. Obviously, Mortensen is a GC, but they of course use many subs. But that is a big part of our diligence, is finding out who is their what's their relationships, because these general contractors, they're not holding prices for more than a week, right? So you've got to be ready to go and lock in. And so that's part of our role. Every one of these projects, we will have a construction manager on Pinnacle's side of the ledger. That's part of the project, as well as Jill and I involved every step of the way. So, you can be assured that we'll do all we can to kind of, be on top of it with the sponsor. But again, making sure these sponsors have those relationships is not just locking in pricing, but it's the availability of GCs, and that you get the best GCs on the project that you can.
So another question here, and it is, we have not discussed the targeted rate of return or the terms of the fund. And of course, the fund is open and available for investment today. We are offering a 7% preferred rate of return, an 85-15 split. We think that's market leading. We're targeting an 11 to 12% IRR, and that is net of fees and promote and before tax benefits. We think it's one of the most compelling, as I suggested, risk-adjusted returns in the marketplace. It is a curated portfolio of 4. It is not a portfolio of 10. We think our ability to execute on this small subset in these attractive growth markets allows us to generate, we think, market-leading returns. So thank you for that question. Of course, we can go into greater detail for anyone that's interested in the investment. I think at 10:01, we're straight up at a little past the hour, and a great place to break. Once again, thank you to everyone that participated. We will have a recording available on demand, and we look forward to interacting with you on the investment opportunity, and we'll continue to provide updates as we seat the 4th project, and we will likely have another quarterly update next quarter. Thank you everyone for your time. Have a wonderful day.
Thanks, everybody.